We'll start off giving a little bit of history here from the lawyer's standpoint. They insist that we put this up. Basically, I'll give you about 3 seconds to read it, understand it. Now, we'll then put it in real language, which basically says, we are not here to solicit products tonight. I am not licensed for these products. The information you receive tonight is maybe useful to you. Please have your advisor check it out. So now we've settled that issue. Let's move on a bit. I want to introduce you to a couple of friends of mine. My friends here, Leroy and Jethro, are a couple of small farmers. And they have invested everything into their farm. But it wasn't actually creating what they had hoped it would. So they came up with a brilliant idea that if they could buy a horse, they could actually create some income. They could send it out for pony rides. They could haul garbage away for people. They could do all kinds of little things that would just create a bit more income for them. So they found another farmer who was willing to sell a horse to them for $100. So they made the arrangement. They paid the $100, and they waited for a week for the horse to be delivered. Well, lo and behold, the next weekend, the farmer drives up, but he's not riding up in a horse trailer. He's bringing a dump truck. And that kind of confused them. Well, all of a sudden, this dump truck goes up, and this dead horse rolls out. And they were shocked. They said, this horse is dead. What are we going to do with the dead horse? You sold us a dead horse. Ah, no, he said, I didn't. I sold you a live horse. It died after you bought it. So technically, it's your horse. And they said, well, what are we going to do with it? And he said, well, I'll tell you what. For $25, I'll haul it away for you. Well, Leroy and Jethro thought about this and thought, you know what, we've already invested $100. If we spend another $25, that's kind of like throwing good money after bad. So they said, no, we can't do that. So the farmer drove away. Leroy and Jethro walked around this dead horse. And they picked up a stick and thought, well, you know what, maybe he's not actually dead. Maybe he's sleeping. Maybe if we wait a little longer, he'll come to life. So they start poking him. Well, it didn't take them long to realize that, no, this horse was dead. He said, you know what? This is another investment that's gone wrong for us. This just seems to be our life. We plan for investments, we invest. Wouldn't you know it, everything goes wrong. Well, sometimes we feel like that as well. We make an investment, we think it's going to help us, and it doesn't work out. Well, they put their heads together and thought, we don't have any extra money to invest. We have to deal with what we have. So they came up with a plan. Well, 2 weeks later, they ran into the other farmer. And he said, hey, boys, what'd you ever do with that dead horse you bought? Or, I mean, that dead horse that I delivered to you. Oh, I said, oh, we did really well. We actually made $898. He said, well, what did you do? You've got to be kidding. No, he said, we decided what we'd do. We decided to have a raffle. So we printed up 500 tickets at $2 a piece, and we raffled off the horse. He said, you can't do that. The horse was dead. Weren't people really mad? Well, the guy that won was really ticked off, so we gave him his $2 back. So, no, that's creative thinking. Taking something we have without putting any more into it and having it come out to be a creative thing. Well, that's somewhat a situation I found myself in a number of times in my life. I am a financial strategist, and it seemed for a long time that part of my strategy was learning lots of ways to lose money, and some very creative ways to lose money. And it took me a long time searching out what actually works. Well, a number of years ago, I was teaching financial planning, and I was teaching strategies to financial planners. And it seemed that I would put a strategy together, we would teach it to the planners, and they would go out, and they would try to sell it to their clients or teach the clients, and they just weren't buying it. And it always seemed to come back to the same situation. People said, we don't have the means to implement it. It sounds like a good plan. We would love to be able to do it, but when we've got mortgages to pay and we've got kids in university or kids in swimming lessons and music lessons and skating lessons and hockey, there just isn't any money. And then we look at the other end. Now up here on the screen, a picture of looking at a puzzle. I look at this as a picture of retirement. Now we all have this, this picture that we would like to retire on. It may be sitting on with weather like this, we'd like to be sitting on a beach someplace with a margarita. Others might like to travel, spend time with the grandkids. We have this picture, but often we don't have the pieces to put it together the way we want. And I found myself in that situation. I was getting frustrated. We moved down from Prince George to the Lower Mainland 20 years ago, when it would be very similar to you moving from Winnipeg to Toronto. It's not exactly a straight across real estate transaction. And at the time I was thinking, saying, okay, we have money from our house, but I wasn't going to put it into a market which at that point was going sideways and actually dropping. We waited for 10 years until 2004 for the market to turn, and when we bought again, we were 49 years old. Now, that's not a traditional financial plan that you start your financial foundation of a home at 49 and then have a 25-year mortgage. And that's a situation we found ourselves in. And it's a situation a lot of people were finding themselves in. So the pieces just weren't fitting. And I knew that there was some major part here, but I just couldn't figure out what it was. So I started to go to seminars, I started to read books, and what came about was cash flow. Cash flow is a word we hear, but often we don't understand it. And even as a financial strategist, it never really came into the plans. And yet, the funny thing is, cash flow is what we live on. Now, a very traditional financial plan would be to go to a job, get an education, get a job, buy a house, pay it off, put money away for your retirement, build this nest egg. But it wasn't working. It wasn't working for us, and it wasn't working for the advisors that I was training. And I looked at a situation, and I read the book called Rich Dad, Poor Dad. I'm sure many of you read it. And he's talked about cash flow. And it's kind of strange. That was like an aha moment for me. Kind of like, I've been in this business a long time, and I've never actually given any thought to cash flow. And I was sitting in the office one day, I work out of the house, and my wife walked in. And I turned to her and said, do you realize that if you and I quit work today, tomorrow our income goes to zero? And she gave me the strangest look, like, yeah, that's why we work. And I said, but isn't that sad that after working for 30 years, we don't have any cash coming in at all? Everything that we're gearing toward is for this future time when we plan to retire. And I said, I'm going to change that. And she said, good, go do it. How are you going to do it? I said, I haven't got a clue. My traditional training has not taught me about this. I'm going to have to actually go out and look at other sources. Now, what I did through a series of a couple of years, I went to a number of seminars, I did a lot of reading, I did a lot of strategies, trying to figure out how can we create cash flow, not just in the future at retirement, how do we create cash flow now? And the result of that journey of our own led me to develop a strategy of turning our mortgage into a pension. And not just a pension at retirement, it actually creates cash flow immediately. We implement it ourselves, we start teaching it to clients, I start teaching it to other brokers. And over time, a number of them said, Gord, you really need to put this into a book. And I said, well, that would be fine, except one problem, I'm not a writer. And I really don't know if I could get my message across to the people I want to. But one thing led to another, and I ran into a publisher. I asked her about my idea, what it would work, and she agreed. She said, yes, this could be a great book. So one thing led to another. I took some time off to write the book, which turned to a lot longer than I had expected. The result was this book, Turn Your Mortgage into a Pension. It was released on Amazon on September 1st of this year, actually hit #1 bestseller in 2 categories and #2 in a 3rd category. So it was received very well. Now, don't get too excited about that. I certainly haven't. I haven't seen 1 cent from it yet. I think what it really says is that Canadians don't buy financial books. I'm not competing here with 50 Shades of Grey and some of these books, which is pretty sad. So I think my next book is going to be how to create a pension by writing a financial book, and you'll be a bestseller because you don't need to sell a whole lot to get there. But what it allowed me to do is take my message out to what I consider the average person who probably wouldn't talk to a financial planner because they have a mortgage, they have credit card debt, they have car loans, they have a job, they may or may not have any type of investments in the future for any type of RSPs or TFSAs, and they usually would not talk to any planner because of that. Well, this was not my idea of retirement, but unfortunately it's become a lot of people's. And now this is a very bubbly person, but I don't quite believe that she is really, really thrilled that this is her retirement, not a retirement. So as much as McDonald's would like us to think that, I don't see it in quite the same way, and that was not my expectation. Okay. Well, a lot of people have no idea what CPP actually pays them, and they'd be shocked. Well, let's look up some statistics here. In 2014, if you were 65 and you retired this year, the maximum CPP payout is just over $1,000 a month. That's after working for 35 or 40 years. Most people don't know that. They assume it's going to be much higher. Now, that's the maximum. Most people don't get the maximum because they either took time off to raise a family, they work part-time, they're self-employed, or entered the workforce later. The average payout in this year was actually just over $600. And a number of people take it early, at age 60, and the government is changing that. In 2015, if you turn 60 and take your pension, it drops by almost another 35%. In 2016, it'll drop 36%. Now, that to me is shocking when this is the foundation for most people's retirement. Now, when we talk about what does it cost to pay off a $250,000 mortgage, most people would say $250,000. Or they'll say, oh, it costs $1,300 a month. Well, there's some things we need to know about what does it actually take to pay off a mortgage. We need to know the amortization, like how long is it going to take? It's going to take 20 years, 25, 30. We need to know the interest rate. And there's one other thing we need to know. We need to know what tax bracket we're in. Now, the interesting thing is, and I didn't know this for many, many years, but the word mortgage has been around for a long time. It actually comes from two French words. The first word is mort, which means death. The second word is gage, or gage, which means to engage. The word mortgage literally means you're engaged to death. And I was feeling that big time, and I think a lot of us do. And I thought, well, this is not the plan. We're not supposed to pay till death, even though it often may feel like it. Well, if we look at the statistics of what does it actually cost to pay off a mortgage, if $250,000 mortgage, when you look at the next line down, I put this is underwater, and often we feel that way with a mortgage. We pay our mortgage in after-tax dollars. What that means is when you go to work and you get paid, your employer does not give you the full paycheck. They have an obligation to pay Revenue Canada. So Revenue Canada is the first partner you have. They take the money from you, and what's left with is what we pay our mortgage with. So this illustration is actually out of the book. We talk about an individual who is an average 20% tax bracket. So in her situation, she pays $97,500 in tax before she gets the money to pay her mortgage. With the assumptions we talked about with the 4% interest rate over 25 years, she pays an additional $140,000 in interest. Well, if we sort of break that down a bit, just run through it, what does it actually cost her to pay her mortgage is $487,500. Aren't you glad you don't live in Vancouver where the average mortgage is $500,000? You can double that. Now, if you look at that and say, okay, she's paid her taxes, she's paid her interest, she's paid her principal. That's a traditional mortgage. Now, two problems rise out of this. One is taxes, we've talked about. The other is compound interest. A bank mortgage is set up for compound interest. Now, we know the term compound. We know that compound interest is either good or bad. If it works for us, if we invest for compound interest, that's a good thing. When we pay it, like to a bank, that's a good thing for them because it's an investment for them, a liability for us. Now, how can we possibly save for retirement when our $250,000 mortgage, which, by the way, I found it is the average mortgage in Winnipeg as well, if your average mortgage is costing us almost $500,000, we look after the bank, we pay them $140,000. We look after income tax, we pay them $97,000. We also have to look after our own self. We have other payments. We have to live. Well, part of the strategy I developed was saying, well, in the situation I was, and the situation a lot of clients were, we don't have extra money. Wouldn't it be nice if we could take some of this compound interest that we're paying to the banks? Wouldn't it be nice if we can capture some of that income tax we're paying to Revenue Canada? And if we could redirect those alone in such a way to invest for ourselves, we literally can create our own mortgage. Now, this slide shows it'd be nice to have CPP and old age security and additional income, whether through a pension or savings. But often we don't realize what it actually takes to get that. If you look at the numbers in red here, if you want $1,000 a month in income and you expect to get a 5% return on your money, you need $240,000. That's what you have to save on top of living and paying off a mortgage. It gets more and more difficult, and understand why people are struggling to pay income tax, pay all their money to the bank in interest. And on top of that, try to put money into an RRSP or a TFSA. Now, when I first saw this number, it struck me that $240,000 is almost exactly the same amount of money that we're paying to the bank and to Revenue Canada. Just a coincidence. Now, that's enough doom and gloom. I'm not here tonight to upset you. We've had a lot of fun. We're going to change a little bit. We're going to talk about some good news now. Well, the good news is the banks are our friend. Now, we don't often believe that. We go, yeah, right. I really enjoy the fact that they're making billions and billions of dollars profit, but unfortunately the problem is that it comes from us. Well, let's actually think for a minute, what is a bank? I mean, we go to a bank, we have our money deposited in banks, we use them for checking accounts, we use them for lines of credits, we borrow money from cars, we get our mortgages. A bank doesn't actually create anything. A bank doesn't manufacture anything. A bank uses our money, loans it out to other people, and they keep the spread. And that's what this picture shows. On the left here we have Ms. Finance Wise, who's gone to the bank and invested $5,000. And Mr. Banker says, here, we will gladly take your $5,000, put it in a term deposit, and give you 1.5%. Well, we also have on the right Mr. Need a Loan. He comes along and he's going to buy a used car and he needs $5,000. So he goes to the bank and says, I need to buy a car. All I can afford is a $5,000 car. Can I please borrow $5,000? Well, the situation does not happen where the banker says, well, aren't you just the luckiest guy? Miss Finance Wise just came in and dropped $5,000. She's getting 1.5%. We'll give that to you at 1.5%. And what a great little mix we've got here. Does your bank do that? My bank doesn't. What they do is say, you can have the loan at 8%. Now, if you notice Miss Finance Wise, she's looking around the corner and thinking, well, wait a minute, that $5,000 that you gave him, that's the money that I put in the bank. So really, who's paying her interest? The person who took the loan out. He pays 8% to the bank, they pay 1.5% to her, and they keep 6.5% for themselves. They keep what's called the spread. And that's really what a bank does. A bank lives off spreads. They don't use their own money. They use other people's money. Well, when this finally occurred to me, I thought, it would be great if I could be a bank. Wouldn't that solve my problems? I can borrow money. I can get a good return on it. I can pay the lender less money than I'm getting on it, and I've become a bank. Wouldn't that solve cash flow? Would you like that? Yeah, that would be a great way to do it. Well, this is taken out of the book here. I'll just quickly go to the snapshot. But this is Miss Finance Wise. She has a home. She has a mortgage, a car loan. She has her term deposit. All of these are little profit centers for the bank. They make money off her checking account. They make money off her term deposit by loaning it back out. The money that she has in her savings account, they turn that into money by loaning it back out. They've given her a mortgage. They're making a great situation here. And they're taking from her in all kinds of ways. Well, there's a better way of doing banking. It's called the all-in-one mortgage. The all-in-one mortgage is not a traditional bank way of looking at things. They say instead of having all these profit centers, wouldn't it make sense that if she's got a mortgage of $250 and she has cash of $7,000, she's making virtually nothing on the $7,000 cash, and she's paying her full amount of interest on the mortgage? That shouldn't work. You should be able to say, well, their net position is not $250. Her net position is actually $243. Shouldn't that be the amount that she pays interest on? And that's really the essence of what an all-in-one bank account is. Now, I plugged the figures in their online calculator. We're not going to read the numbers, don't worry. What the traditional mortgage shows is that it takes 25 years to pay off. The all-in-one, with her same cash flow, no change at all, takes 15. Now, if that's all she did, that would be an amazing savings for her. What she could do then with the traditional way of planning would be pay off your house and then start saving for retirement. Well, that could be one thing. Now, when I first heard about the all-in-one mortgage, that was my second aha moment. I went, wait a minute. There might be a way that I don't actually have to pay off my mortgage if I combine it with different ways of doing it. Now, that last slide, somebody had probably noticed that it says in the bottom 4%. They're going, I knew there was a catch. You got a mortgage at 4.5, you're replacing it with a 3.5 mortgage. Well, that's a no-brainer. When you reduce the interest, of course you're going to save money. Well, mortgages were at 4% when I first wrote the book. Today, they're about 2.95. So to get rid of that argument, I plugged the same figures in, but I used 2.95. Still takes 25 years to pay off the mortgage. The only difference is instead of paying $1,300 a month, she pays just under $1,200. If you look on the right, the all-in-one mortgage, nothing changes. It's the same. Now, the interesting thing is that the principal pay down really starts to accelerate. Now, with a traditional mortgage, when you pay the principal off, it's gone. A bank doesn't really want that money sitting idle. You take the money, you pay it back to the bank says, great, I've got $10,000, you paid me back now. I still owe the saver this money, so they want to get it out right away and loan it back out. Well, that's a great, remember, that model works well for the bank, and I want it to work for me. With the all-in-one mortgage, when I pay that mortgage down, I don't need permission to take it back. Now, if I take it back and I say, okay, I will borrow it back to the bank, you don't have to worry about looking for somebody else. I'm going to be a bank, so now I'm taking other people's money and I'm going to invest it. Now, if I'm thinking like a bank, I want to invest it like they do. I want to invest it in debt. I want to invest it in mortgages. So I'm going to introduce the concept of what's called a mortgage investment corporation. That's what a MIC is. A mortgage investment corporation is a private bank that is owned by the investors. And we're going to hear a little bit more about that after Steve comes up, so I won't spend a lot of time on it. The idea now is that what I've done is I've created myself in a situation where I can act like a bank. With the same cash flow I had, I can pay down the bank, borrow it back, and invest just like a bank. Now, the difference is the spread comes to me, so there's another layer in there. So we have now using other people's money, and when that happens, we literally are creating a pension for ourselves. We keep the spread. Now, the reason I like the Mortgage Investment Corporation is not only that it just is like a private bank, it is a bank, and I'm going to work on spread. Now, this chart, the bottom section, which is the bar graph, I guess we'll call it, in blue, that is the actual all-in-one bank base rate since 1999. The red line above it is one of the largest, most conservative MICs in Western Canada. And it's interesting, when I plugged in their return over that same period, it almost mirrors the bank rate. And to me, that's very important, because if I'm looking for a spread which creates a pension for me, I want to make sure that if the bank rate goes up that I'm paying, that the corresponding investment's going to go up as well. So in other words, if the bank rate now is 3.5 and I'm earning 7, I've got a 3.5% spread. If the bank goes up to 4 or 4.5 and the spreads stayed the same, all of a sudden I would be losing my pension. But if the spreads and keeps in conjunction like it does, I can float it and it looks just fine. It keeps my spread. Now the green line above, that is actually the MIC company that Steve is going to talk about. They've even done better than the one that I've projected here. I wanted a very conservative one. I wanted one that would show that this works over a long period of time. If you can do better, obviously your spread is going to do better. Now this is we worked a long time on this diagram to have it to say what we wanted. The top line is stairs that represent a traditional mortgage. This is a mortgage where Miss Finance Wise has a 25-year mortgage. She's paying $1,300 a month every month for 25 years. It's not cash coming in, it's not cash flow, it's cash flow going out. She has missed payment every month as an expense. If you use the same structure that we talked about the pension, cash flow starts in year 1 and grows every year. In approximately 8 years, the spread on your investment will make your mortgage payment for you. And then it turns the other way and actually starts getting positive. By the time you've hit 25 years, you're actually making about $1,200 a month. In other words, somebody is paying your mortgage for you, and on top of that, they're giving you an extra $1,200 or $1,300 a month. Now that was a huge aha moment for me. And when one day my wife came into my office again and I said, guess what? We're not going to pay our mortgage off. And she looked at me kind of like, you sound excited about that. Weren't we planning? She said, we don't want to have a mortgage when we retire. And I said, well, why not? She said, well, we don't want to have a mortgage payment when we retire. My parents didn't have a mortgage payment. Your parents didn't have a mortgage payment. I said, no, but if you didn't have to make the payment, if somebody else made the payment for us, and on top of that gave us an extra $1,000 a month, would you mind having a mortgage? She said, no, not at all. How do we do that? I said, well, I'm not quite sure yet, but I'm going to find out. And that's what the book is about. The book is about my journey of how did we actually discover it. We use it. It works really well. We've taught a lot of people how to do it. They're using it. It works really well. But the great thing about it is that there's no cash outlay. We're not having to add additional dollars into our investments. We are just using dollars that we already are directing towards the banks and Revenue Canada, and I explain in the book how we do that. That's what builds a pension plan for us. We're going to talk about an old adage called hold on to your fork. I want to have you leave something tonight with a visual image. We all know how to use forks, so that's a good starting place. So, when I was growing up, my favorite dinner was Sunday. Sunday dinner was the night that my mom made pot roast, and we had her rhubarb chutney, which was amazing. We had mashed potatoes and the best gravy in the world, which my wife that's still a stickler with us. She has tried to duplicate it, but she can't. Nothing's like my mom's gravy was. But when my mom finished the meal, or had made the meal, it was the kids' job to clean the table off. And as we're doing that, we heard these magic words. Hold on to your fork. What did that mean? Dessert's coming, absolutely. The best is yet to come. And that's what you hold on to. And that's what I want you to hold on to tonight. By starting this strategy, the best is yet to come. Zig Ziglar said, it's not going to be easy, it's going to be worth it. Now, what it means by this is the biggest temptation we have when we're already fairly tight financially is when the cash flow begins, we spend it. If we do, we will have fun, but it's not going to work the strategy. We have to be committed to say, we know what we're working toward. We know that we are using this for going forward, and it does get easier. Stay disciplined and it will work. Now, last thing I want to say, an ounce of action is worth a ton of theory. You can read all the books you want, you can go all the seminars you want, you can do all the teaching and learning. Unless you actually take action, nothing's going to happen. Now, tonight this event was put on by Brooks Financial. Brooks Financial can help you implement the strategy. They can teach you what products to use, how to use them to make you CRA compliant and get you on the right path. So thank you very much for your time.